Hello, and welcome to today's webinar hosted by Left Brain Professionals. I'm Steve Bressler, and I'll be your moderator today. If you need any help at any time, you can email us at support@leftbrainpro.com or use the Q&A function within the Zoho platform. Let's go over a few housekeeping items. Today's webinar is hosted on the Zoho platform. You should see a small toolbar with 5 icons in the bottom middle of your browser window. The first button opens the Q&A panel. The second button opens the poll panel. The third button allows you to interact with us and chat. The fourth button opens the additional settings. And the fifth button allows to end or leave the webinar. By selecting additional settings, you can access the audio and video settings, network performance, preferences, and other items. If you have connection or audio issues, please try the following solutions. Turn off your VPN, exit and re-enter the event, try a different browser, connect to your personal PC, phone, or tablet, or you can download the Zoho webinar from your app store and run a speed test, potentially using speedtest.net. Please enter your content questions in the Q&A panel at any time during the presentation. We'll address as many questions as we can. And in order to receive credit for today's presentation, you must respond to 3 of the 4 polling questions. Certificates are generated automatically and will be emailed within 48 hours after completion of the webinar. And a short 6-question survey will display in your browser at the end of today's webinar. Please take a few moments to answer the questions and provide any feedback. The recordings of today's presentation will be available on our YouTube channel and in the link that will be included with a follow-up email. Thank you for your attention, and without further delay, I will turn it over to Robert for today's content.
Well, good afternoon. Thank you, Steve. Good morning to my friends and colleagues here on the West Coast with me. As many of you have probably seen in the national weather that California is getting hit with a lot of rain and snow. Luckily, I'm south of most of that, but it's in many ways welcome weather for us because we always need a little extra moisture out here. All right, our topic for today is issues in the incurred cost proposal preparation and audits. It's a fun and exciting topic for us, seriously. We do a lot of work with the incurred cost proposal, and I'm sure that Steve and Suzanne will be chiming in on some of the items that we cover today. Really quickly about us, if you're unfamiliar with Left Brain Professionals, we're a boutique accounting firm that works only with government contractors. We specialize in operational support and advisory services. Within our practice areas, we do a fair amount of work with CFO and controller services, strategic planning, various audit support. We do offer monthly accounting support, as well as helping you design and implement your accounting software and provide a number of templates and tools. You've seen all 3 of us on the screen here today. Again, if you contact us, support@leftbrainpro.com, that goes into a group mailbox, and all of us will have an opportunity to respond. I do want to launch a poll question here just as we get started. So let me put that on your screen.
I'll go ahead and read the poll question for you, Robert. Have you been through a DCAA incurred cost proposal audit? Yes, several. Yes, only one. No, or you're not sure.
We will leave the poll question open for just a few more seconds. Remember that you do need to respond to 3 of today's 4 polling questions in order to qualify for CPE credits. All right, it looks like most people have responded, so I'm going to go ahead and close this and share the results on the screen. And you can see that we've got about half the people who have not been through an audit, which I would say is good in some ways. You've avoided some of the pain that we've been through, but if you're a government contractor and if you deal with cost type contracts and the incurred cost proposal, at some point you will be audited. It happens. Many of you may be in that low risk category right now, and maybe that's why you haven't been audited, but even in that grouping, at some point, it's very likely you will be audited. Our learning objectives for today, at the end of our time together, you should be able to describe the job cost ledger reconciliation, identify issues in labor reconciliation, recognize missing and disorganized data, and list common audit findings. Before I get deep into the content here, I do want to share just a little bit against more of the background of where we are in this topic and what we've decided to present. So many of you may have seen our incurred cost proposal presentations in the past. If you did not, or if you want to see it again, those videos are available on our YouTube channel. Simply go to YouTube and search for Left Brain Pro, and you'll find about 45 videos out there. In the past, and what a lot of firms do typically this time of year is we kind of walk through what is the incurred cost proposal, when is it due, what's on each of the schedules. And certainly that's valuable information if you're new to the incurred cost proposal. But we figured out that we've done that presentation ourselves a few times, as well as other firms. And so we said, let's take a little different spin this year and really focus on some of the issues that we see over time and walk you through how to avoid those and how to reconcile some of those issues. The first topic is that job ledger reconciliation. This is where, if you've been with me before, you've heard me say that the sum of the parts must equal the whole. Basically what this means, and I'll give you a couple of examples. If you were to print out the job status reports or job progress reports, whatever your system calls them, and you printed them out for all of your jobs for the year, you should be able to add up, right, the summary information from each of those jobs, total that up, and that total should equal, right, what's on the general ledger. A different way to look at it for those of you who are in QuickBooks, you're probably familiar that if you run a number of reports in QuickBooks, whether it's by whether you're using categories or tags, whether you're running it by departments or accounts, if you have transactions that have not been coded, at the far right of that report in QuickBooks Online or QuickBooks Desktop, there's basically a not assigned, right? So you would have like job 1, job 2, job 3, and then in this last column, you would have some expenses that were not assigned. That's a problem. If you've got here, particularly when we're talking about the job ledger, and this applies to both revenue and whether you call it COGS or the direct expenses, that gross margin portion of the report should always have a job or a project associated with it. That way, when we get to completing the Schedule H of the incurred cost proposal, we know then that when we list out all of the jobs and we list out labor, material, travel, ODCs, and subcontractors by job, when I get to the bottom of that column, whatever my total direct labor is on Schedule H, which would be my total direct labor for all of my jobs, that should equal my direct labor in the general ledger. Now, some of you might say, well, shouldn't it always do that? And my argument is, yes, it should. Part of the way that you achieve that, one would be a process aspect within your system. And this is where, for example, QuickBooks Online and QuickBooks Desktop fall short, is we cannot make that a required field within QuickBooks. We cannot. It's not, that option does not exist. Now, if you're using other systems out there, you can say, when this, when this account is used, it always has to have a job associated with it. And then the system will not allow you to complete or post to that transaction until all of those code parts associated with that transaction have been included. So I would say that if you're using something like Microsoft 365, the GovCon 365, Uninet, some of the other tools out there, they should allow you to make that configuration. That's going to help you ensure that, again, the sum of the parts equal the whole. Because obviously, if the sum of the parts don't equal the whole, then we run into issues trying to reconcile Schedule H and other things within the incurred cost proposal. And again, this should, yes.
Oh, I'm sorry. I was just going to say that, to what you're saying, that you're only as good as your setup. So many times when these don't tie out, we've gone back and whatever the jobs are that have caused problems typically are the ones still causing problems. They have bad setups, or they got started and then they got canceled, or costs didn't get backed off of them. Generally, the costs end up hanging out there. And in our experience, this is the first place the auditors go, is they look at your trial balance and they try to tie it back out to Schedule H. And if you don't tie right there, you're already in trouble. It's a pain to fix it, but if you don't, you're done.
Yeah. And in fact, one of the schedules within the incurred cost proposal, Schedule G, is to do that. It's to make that reconciliation, and you're going to see that kind of issue pop out. Yeah, the other thing that I was going to say, and your point is correct, that if the job itself hasn't been set up correctly, or if the system has not been configured correctly, that'll cause a problem. The other is that people do journal entries, and some of this, again, is a process issue, but some of that, again, is also a configuration issue in the system. We find sometimes that people are doing journal entries on either level. Sometimes we find that people are doing journal entries at the general ledger level and they're not associating the appropriate project with it. So that causes the discrepancy between the general ledger and the job ledger. And the reverse is true. There are some systems that will allow you to make changes at the job level through a journal entry that don't flow to the general ledger. So you got to be careful of all of those types of issues. When we're talking about the job ledger reconciliation, just a quick overview of where the data is going. All of your job cost, and note that I focus on the cost, the job cost details go into Schedule H. So that's all of your cost elements for direct labor, materials, travel, ODC, and subcontractors. For your T&M stuff, your T&M invoice data goes to Schedule K, and your job invoice summaries go to Schedule I. Now, what's interesting with Schedule I, and the reason we bring all of these up, is all of this stuff is connected. Your job cost details, and that's for, let me back up for a moment. That's for all of your job types. So cost type, flexibly priced, T&M, fixed price, all are listed on the Schedule H at the job or task order level. Again, we have the breakout by cost element. We have the breakout by contract type. The only exception to that is your commercial work can be listed as a single line item. We don't have to list out all of the details of your commercial jobs because obviously they're commercial. That's not what the government is looking at, but you do need to list the total of all of your commercial work. And again, that can be as a single line item. For T&M jobs, we do have to have that detailed information. And so that is the labor category, the quantity of hours, and the rates by labor category that go across and give us the total amount that was billed by labor category by contract. That's one of the areas that we find a number of clients struggle with that kind of information. And then our other job invoice summary stuff goes into Schedule I. So our cost type contracts and our flexibly priced, we need the summary or total invoice to date, and that's inception to date. Goes in the top portion of Schedule I. The T&M invoice information. So notice up above, I said the T&M invoice details go to Schedule K. the T&M invoice summary information comes from Schedule K and goes to Schedule I on the bottom portion of that tab. So hopefully that makes sense and you begin to see where the information goes and start to see how it flows through and connects within the incurred cost proposal. Our next topic is issues in labor reconciliation. So this is the one that, and I've said for years, and I hear other people say the same thing, Schedule L is probably one of the most difficult schedules to reconcile. And interestingly enough, it doesn't necessarily have a lot of data. So in comparison to, for example, Schedule H or Schedule K, where we have detailed information by contract, and we've got a long list of contracts or task orders. Certainly those schedules have their reconciliation issues, but what's interesting about Schedule L is that it's very difficult to reconcile, and we're going to talk about some of those issues in a moment. But first I want to clarify, what's the purpose of Schedule L? Other than we're trying to reconcile stuff, what is the government really looking for, and why is Schedule L so important? It's important because the government wants to make sure that you are not claiming as a cost labor that you did not pay taxes on, right? So they're essentially looking for fraud here. They're trying to figure out, hey, did you pay? And I'm going to make up some numbers. They want to make sure that you did not pay payroll taxes on $500,000 of labor, but you're claiming $600,000 of labor in your incurred cost proposal, right? That would indicate either you're being fraudulent and you're claiming more costs than what you actually paid and paid taxes on, or, and I would say probably, at least in our cases, 99+% of the time, it's not that the clients are trying to commit fraud, but that they've got reconciliation issues and other problems that we're going to talk about here on this next slide. So what are some of those issues? And what you're going to find on this first slide is it's around the labor accounts. So labor accounts are not clearly identified. When we help people set up or configure their accounting system, we have a chart of accounts. What you'll see in our chart of account template, what we recommend is that your labor account name needs to have the word labor in it, right? Let's be clear that this is direct labor, this is overhead labor, this is G&A labor. It's also very important that we're very sensitive around things like subcontractors, independent contractors, temporary labor, because those issues affect the proper calculation of indirect rates, and they affect how stuff is reported in the incurred cost proposal. So for example, if you have temporary labor, that needs to be a separate account that clearly identifies temporary labor, because temporary labor, for example, is we don't pay taxes on it, right? So it wouldn't go to Schedule L. They're not our employees, so we're not paying the fringe benefits, so they don't go to the fringe calculation. So we've got to be very careful with those types of things. Very similar for any kind of independent contractors or subcontractors that we use. Again, we're not paying their benefits, we're not paying their taxes. If we don't properly, one, label the accounts, and two, make sure that stuff is coded to the correct account, then that's where we start to run into issues with labor reconciliation. Related to that, we often find that clients are commingling expenses in accounts, meaning that they no longer have a homogeneous account. Let me give you an example. We sometimes see that people will set up a training expense account, like in overhead. And what'll happen is that they'll put the cost of the training seminar or the training class in that account, and then they'll put the training labor expense in that account. So now all of a sudden, if the account doesn't say labor, then I don't know that there's labor in it. But regardless, even if it said labor, if you're coding other stuff to that account, then it's no longer a homogeneous account. It's no longer just labor, it's now labor and other stuff. So we have to be very careful that we keep our accounts homogeneous and we keep them clearly labeled.
Robert, we tend to see
Yes.
that quite a bit in the travel accounts too.
Yes.
That people will charge their travel, just that actual travel time, into the travel account and then put their work time on whatever the job code is. So it's not unusual when you have outstanding labor and you're trying to get this reconciliation as close as possible to literally comb through each individual account, searching for those labor entries. And again, I think you mentioned journal entries earlier, and the journal entries can get in there and throw you off too. So you have to keep an eye on the types that you're looking at when you go through the accounts.
Yeah, and that's very important stuff. And one thing I want to highlight about what Suzanne just said is, what did she say? It takes time to scroll through and dig through those accounts, and time is money, right? So you're spending money, you're spending time. You may be, and in fact, what we often see is that clients are delayed in a timely submission of the incurred cost proposal because we have some clients that we have literally spent weeks and months trying to reconcile the data and get it to a presentable fashion.
Real quick, I would add as well, I've done a lot of client preparation. When you think you are done and you get to Schedule L, the only thing I want to add, as the 941s come out quarterly, it can be a huge advantage to look at the first quarter and see where you're at before you think you're done with the incurred cost proposal and you're looking at the whole year and chaos ensues.
Yeah, the other good thing with that, one of our recommendations is to do a monthly or at least a quarterly payroll reconciliation throughout the year. Because if you don't, again, we get to the end of the year and we're trying to sort this out. And so we're trying to find issues that sometimes occurred 12, 15 months ago or more. And it's difficult to find and fix those. Whereas if you identified them within the month or within the quarter, it's much easier and cleaner than when we get to the incurred cost proposal. It's easier to get through that process. The other thing, and it's kind of related to this and what Steve was starting to say with the reconciliation, what we find is that the labor accounts and amounts that are used are not consistent with those used in payroll. And so what I mean by that is, for example, we recently were working on a client's stuff. They had some accounts labeled as labor. And when we dug into them, what we found is that it wasn't labor, it was actually moving expenses. So they, and that caused us a problem because we said, okay, give us all the accounts that you are, paying payroll against. So you would think, and they gave us and said, okay, well, we pay payroll against this account. Well, it's not late. It might be a payroll expense. So kind of what I'm getting at here, and then there's some tax issues and it's beyond the scope of this. For example, with the moving expenses, some moving expenses might be paid by the employer, but they create a tax issue for the employee. And so they have to be reported on the W-2 as an example. And so they affect the employee's taxes. They become a payroll item, but they are not labor, right? So hopefully you understand what I'm getting at here is make sure that that stuff is clearly identified, because if the accounts that payroll is looking at to generate what they need needs to match what we're looking at and using as labor. Other key issues here, adjustments made in payroll, but timekeeping, labor distribution, or the general ledger. A couple of examples are bonuses. What we've often seen is that people will process payroll and they go, oh man, add that bonus in here. I'm going to go ahead and add it. I'm going to fix it in payroll. So they fix it in payroll. The employees is happy about it, but they forget to go back and run that information through timekeeping, labor distribution, and or the general ledger. So now all of a sudden we've got a variance between our payroll reports and again what we've reported in the general ledger as a labor expense. PTO payout, again, is another similar issue. So you have an employee who's terminated, whether they've terminated themselves or they got terminated by the company is irrelevant, but they've terminated, you're now doing a PTO payout. And again, sometimes, and I've been in the middle of it myself, I've seen it happen. You start processing payroll and all of a sudden the payroll person goes, oh, wait, we forgot to put in their 80 hours of PTO that they had. So they fix it on the payroll side, so the employee gets the payout, but they forget to go back and flow that information through timekeeping, labor distribution, and the general ledger. And there's some other trickle effects with that, because if we don't process that PTO payout correctly in timekeeping and get those hours off the books, then our liability is overstated, right? So that's affecting our balance sheet. Again, it can affect labor distribution and how those dollars are populated, and we may not be properly recording the expense in the general ledger. The 941, our next issue here, the 941 is not easily reconcilable to the payroll summary report. And this is often due to pre-tax items or other adjustments. So here I want to say another thing. When you're working on Schedule L, the ICP template asks you for the 941s. If you take just the 941 dollar amounts and try to reconcile to Schedule L, you're probably going to run into issues regardless because of pre-tax items, right? And pre-tax items, what I'm talking about are things like 401k deductions, FSAs, other types of things that affect that line 1, line 5 kind of stuff on the 941. They're wages that are paid to the employee, and that shows up in box 1 of the W-2, but it does affect how things flow through again to the 941. This is why one of the things that we always request when preparing somebody's incurred cost proposal are not only the 941s, but the year-end payroll summary report. So that is a list of employees, the total hours they were paid, total dollars, total tax deductions, all of that kind of stuff, so that we have a summary by employee, we have a total summary for the organization, and be able to tie that information back to the incurred cost proposal. And there are a couple of things there that we can tie out. One, we can tie out the total labor that was paid out. We can also tie then back to the 941s by, again, making the appropriate adjustments for pre-tax and other stuff. The other thing is that we can also make sure that the dollar amounts that are claimed in fringe for things like FICA, FUTA, SUTA, and other types of taxes, whatever the total amount is, right, that you reported on, or that's reported in your payroll summary report, should tie to the amounts that you're claiming in the fringe pool. So there's a couple of things that we can do there. The last item on here, payroll accrual entries are always problematic. Either the entries are not clearly identified in the information that's provided to us, they were incorrect, there's some kind of issue, again, that they don't tie to what was paid out in payroll. One of my recommendations to clients is that you create a separate account to post your payroll accrual entry to. So if you, for example, if you have a direct labor account and you're going to have accrued direct labor, you should have a separate account for that accrual. That way we're not commingling labor distribution, the actual timekeeping, the timesheet posting transactions. Those should go into the base labor account, and all of the accruals go into a separate account. And then it's much easier to identify, for example, hey, do I have an issue in what was processed through timekeeping and labor distribution, or do I have an issue with how the payroll accrual was calculated, as an example. Steve or Suzanne, you guys have any further comments on Schedule L?
I would just stress the importance. I think it's right up there with the importance and the complexity of Schedule I. And often I and L are schedules that are done more of an afterthought than a focus.
You're right. And that's something that we've encountered, Steve. I know you and I have lived this many times, is that you work on A, B, C, and fringe. You work on Schedule H because you need A, B, and C and fringe in order to complete Schedule H. You get all of that stuff together. You start working on other reconciliations. And Steve, I can think of a couple of specific clients. You and I finally got to Schedule L, because again, it's also, you can't really do Schedule L until you do the other schedules, right? I mean, if you haven't populated all of Schedule H and calculated your direct labor, if you haven't completed B and C, to have your overhead and indirect labor and fringe to get your paid absence labor that goes into Schedule L. Schedule L, I don't want to say that Schedule L is an afterthought, but Schedule L is something that happens later in the process. And something we've encountered is that we get to that point, now Schedule L is out of whack. We start finding the issues in Schedule L, but what we discover is that, again, there sometimes there are things that are that only affect Schedule L, but oftentimes what we find is that there's an underlying problem in what was reported as direct labor or G&A labor or overhead labor. Now that means going back and fixing the other schedules, which adjust the, that's going to affect your rates, and those rate changes are now going to flow throughout all the other schedules.
So, year over year, if you're with the same place and you have the same payroll people, I had noticed in a prior position that the poor payroll person would be just dismayed when at the end, Schedule L was all that was holding us back. So she started doing her own reconciliation. I don't know why the camera keeps going off. She started doing her own reconciliation on a much more frequent basis. So, every month she would sit down and do a reconciliation, because those, those late hours that were coming in, things like that would always, late hours and bonuses would cause some of the biggest problems. So.
Right. Yep. All right. We've got another polling question here, so let me start that.
All right. Which of the following are issues in reconciling labor? A, labor accounts are not labeled. B, commingling expenses in with labor. C, pre-tax items. Or D, accrual journal entries.
And this is one that you select any or all that apply as an answer.
We've got quite a good response rolling in. We'll give you a few more seconds to make sure you can get the credit and see what everybody says.
All right. Looks like we've got most people, so let me share the results. So the correct answer is all of these. So hopefully some of you did select all of them. Remember that we talked about the importance of labeling labor accounts, making sure that we don't commingle expenses, knowing that pre-tax items are going to affect the total amounts that we see on 941 and how we reconcile that to total claimed labor within the incurred cost proposal. And again, various issues with accrual journal entries. All right, now back to our presentation. Our third topic today is missing and disorganized data. So, right, the devil is in the details. And I would say that in general, that's the other area at a high, how do I want to say that? Probably one of the number one issues from a generalized perspective is that we run into issues sorting out various variances and these discrepancies. We typically, I'm going to say typically, don't have problems completing schedules A, B, C, fringe, some of the other schedules. General ledger is usually available. Job ledger is usually available, though we've run into some issues with that. But it's when something doesn't tie out, when there's some kind of variance, and that's where we end up spending our time. That's where that's where clients end up getting the larger invoices from us, because there's a fair amount of effort in those details trying to get everything right. Specifically, what we see is just pure missing data. The data was either never collected or it was never collected at the appropriate level of detail. For example, on Schedule H, you are supposed to collect and report those direct costs and invoicing at the CLIN level, right? If you've got CLINs identified. And oftentimes what we find is that clients are collecting information at the project level, but they didn't properly set up their project with the appropriate sub-projects or tasks, or again, whatever your system calls them, so that they actually have the information by CLIN. In the best scenario, when you set up a project, your project should match the same setup as your contract. So if you've got a contract and you've got 5 CLINs, then you should have a one-to-one relationship of project to contract. And further, you should have if you've got 5 CLINs on the contract, then you should have 5 line items underneath of your project in your system. Now, I will say that we've seen some people break down those individual sub-projects or CLINs further because they have internal reasons that they want to track and report how they're doing stuff within a CLIN, and that's okay. You can certainly have greater detail within the CLIN, but you need at least the same level of setup between the contract and the project so that we can report that appropriately. And that is one that we have seen DCAA pick on time and time again with clients, is that the client has the information at the project level, but they don't have it at the CLIN level.
I really quick want to add, that's a great point, that we've seen this very, very commonly, multiple clients, but there's also a potential that you could have 2 CLINs from the same contract or project that would be in different sections on Section 8. If you had a fixed price award with cost reimbursable, then that reimbursable CLIN would be a cost type reported line on Schedule H, and the remainder would be in the fixed price.
That's a very valuable piece of information. We do have a number of those hybrid CLINs, and that is something that DCAA has picked up. So you have to remember that when you submit your invoices through wide area workflow or through another portal to whichever agency that you're working with, right, that agency now has that invoice information. And so that's something that has popped up. A couple of things have popped up around that. Either that the client was invoicing incorrectly and was later determined that they were collecting the information incorrectly and invoicing incorrectly. We've actually also seen where the information was collected incorrectly in the job status report, but the person creating the invoice found the issue, actually created a correct invoice in wide area workflow, but the job detail information that was provided for the incurred cost proposal didn't match. And so DCAA said, wait a minute, you build this structure over here, but you're claiming a different structure in the incurred cost proposal. So we have to be very careful about those discrepancies. The next item that we see with data is that data is captured in multiple tools that were never reconciled. So this can happen where you have disparate timekeeping, accounting, and expense reporting software. Maybe you're doing manual uploads. Maybe somebody's manually keying information. We still have clients who are doing paper timesheets and Excel timesheets. And so things, again, we find that people they're making a correction, maybe again at payroll, but they're not going back to the timekeeping system and actually processing that change through. And that's, I have to say that across the board from an accounting perspective, whether it's AP, AR, timekeeping, anything, we need to be very careful and not make journal entries. Journal entries should be really the exception. We should not default to say, oh, I'm just going to make a journal entry to fix it. If there's a problem, we need to go back to the source document. We need to go back to the source system and and correct it there and let it flow through the entire system. Related to this, though, with having stuff in multiple tools, is that we are often left trying to help the client cobble together their entire story, right? The incurred cost proposal really is a story. You're telling the government at the end of your fiscal year, here's all the work we did. Here's the type of work we did by contract. Here's the work we did, by contract, by CLIN. Here's the money we spent by cost element. Here are our indirect rates. And you're building this all up in a story, and the punchline of the story is Schedule I. It's okay. When it was all said and done, did we over or underbill the government? And we want to tell the most accurate story, right? We want to make sure that we're presenting everything correctly. But unfortunately, we're oftentimes, again, cobbling together information because we need a certain level of detail, again, for Schedule K. We need a certain level of detail for Schedule I, or Schedule I and J and Schedule H. And sometimes what we find when we go to ask clients for that information is that they're pulling Schedule J information, for example. They might be pulling from an Excel worksheet where they're tracking their subcontractors. They might pull Schedule K information from timekeeping, which they shouldn't be. It should be coming from invoicing. But even if they're pulling it from invoicing, sometimes people are using an external tool to create and manage invoices. And then we're getting the general ledger information right from a different tool. And if these tools get out of whack, that's where these variances come in. That's where it becomes difficult to piece all of this together. And what I should say, and probably what I should have started out the presentation with today, we are seeing an extreme amount of scrutiny by DCAA on the incurred cost proposals. It's not just us. I talked to others in the industry. They're saying and hearing the same thing. We gained a number of new clients this year because they were oftentimes in the past preparing their own incurred cost proposals, didn't have any issues, and now all of a sudden in 2020, 2021, they were getting several rejections from DCAA. They were ending up in audits. DCAA is scrutinizing every minute detail within the incurred cost proposal. So if there's a discrepancy, if there's a variance, they're going to find it and they're going to pick on it. And what we're seeing, and I have to say that largely one of the things that we're seeing that's also frustrating related to this is that it seems that DCAA has lost the concept of materiality. We've seen them argue over a few hundred or a few $1,000s when we're talking about millions of dollars of total, which is kind of its own separate issue. But you can see that they're honing in on any of these variances and they're marking the incurred cost proposal as inadequate, right? And they're kicking it back to the contractor. And so it's more work, it's more time, it's more hassle. So we have to have this data as clean and organized as possible. The last item here is one that I kind of said a little bit ago when I was talking about the job ledger reconciliation. And I think we've said it a couple of different ways, but either costs and invoices are associated with the job or not at the correct level, meaning at the CLIN level. So again, if you've got CLINs on your contract, it's got to be reported that way. If you have an IDIQ, the report is not done at the IDIQ level. The report is done at the task order or the delivery level. Remember that the IDIQ is not an order, right? It's the agreement of how we're going to order, but it's actually the delivery order or the task order that is the order, and that's where we have to do the reporting. So again, that's another area where we've seen contractors not properly set up their data collection. All right, let's dive. Go ahead.
Oh, go ahead, Robert.
You're fine. Go ahead.
To just add on to what Robert mentioned about the scrutiny, within our clients, even when they did raise questions or marked it inadequate, oftentimes we could do a resubmission. Recently, there has been the audits come up before the resubmission where they don't give you the opportunity. They just say, we're going to audit the whole incurred cost proposal.
Yeah, it seems to, I'll just say that dealing with DCAA over the past roughly 2 years, we've just seen a huge swing, again, in the scrutiny. We've seen a huge swing in how they deal with stuff. Unfortunately, we have found that they've generally, and I hate to say this, I don't like to use broad stroke comments, but it's what we're seeing. We've got clients coast to coast. We're interacting with DCAA field offices all over the country, so it's not like we have experience with one office or or one set of auditors. We're seeing commonality. Again, we're hearing this when we talk to others in the industry. But it's been a crazy time dealing with DCAA. A lot of that has certainly come from PPP and the other COVID relief programs. We knew that. I predicted it, as I'm sure many others did. I'm not necessarily a genius in that area, but I said, hey, if the government's going to be handing out all this money and doing these grants and all of this kind of stuff, they're going to have their eye and their finger on what's going on, and that's certainly part of what's happened with DCAA is they've really been digging into the PPP credits, the employee retention credits. A number of states have had grants that they've passed out. All of those kinds of things, they affect the presentation of the incurred cost proposal. They affect the proper calculation of indirect rates. They affect the proper calculation of total contract cost. And again, you can imagine that DCAA is going to be looking at all that stuff. All right, specifically to audits, because again, as Steve was just saying, we've been seeing not only an increased scrutiny of adequacy, but also now we're seeing more clients go into audit that never went into audit before. So those issues fall largely into 4 areas. These are by no means all issues or all areas, but again, just some of the more common ones that we see. It's around missing data, large variances, data inconsistencies, and other issues. So missing data, first and foremost, if you can't support the expense, it will be disallowed. What we have found is that clients, I've seen some pretty extreme situations where clients did not have receipts and invoices to support claimed costs. They went through audit, and guess what? DCAA disallowed those expenses because the audit contractor couldn't support them. On a similar fashion, and a lot of this is tied back to Schedule H, one of the things that we've seen is that contractors had back to the reconciliation, I should say, of the job cost ledger to the general ledger, is that they had a number of expenses at the general ledger level for which they did not have the project IDs at the job cost level, so there was no way to claim them. They knew those costs went to a job, to a government job or a government project, but they didn't have the proper information in their accounting system. And even after digging, they couldn't figure out the proper way to do it. And we've had a couple of particular clients that ended up moving either tens, and in one particular client's situation, they moved $800,000. Listen to what I'm saying. They moved $800,000 of otherwise legitimate and what would have otherwise been allowable direct expenses got moved to unallowable because they didn't have the proper detail to be able to support which project it went to. And so if you can't identify which project it goes to, then it goes to no project, right? You can't just lump those dollars into a project if you can't prove it. So they moved over $800,000. And this is, I mean, they're a decent sized company, but not that huge, that $800,000 of expenses went to unallowable because they simply couldn't support it. Back to some of the scrutiny that we're seeing is incomplete schedules, not answering all the questions or providing all the data that's requested. Now, again, one of the struggles that we run into is that sometimes clients don't have the data. And sometimes we've had to, as best we can, try to explain to DCAA, you can ask all day long, you can ask all you want, you can mark it as inadequate, but the data doesn't exist. We're sorry, we can't fix it. We can't recreate something that didn't happen. And unfortunately, that's an issue. Again, unfortunately, in this area, sometimes what we've seen and what I started to say earlier, I kind of hate to pick and paint a negative picture of DCAA, but some of it is a reality. We've been unable to have a meaningful conversation with the auditors and say, look, we know there are problems with the incurred cost proposal. We know there's missing data. but this is where we are. Let's all let's have a web conference. Let's walk through it. Let's explain what we have. Let's explain why we presented stuff the way we did, and try to get through this. Because that's been the other thing, is that there have been a few times where, again, because the client had kind of messy data, we cleaned it up and organized it as best we could. And like the old saying goes, in a couple of cases, we were putting lipstick on a pig. And that was about the best that we could do. Steve's laughing, but he knows, because we lived it. It was an ugly mess, but unfortunately we couldn't get in front of DCAA to walk them through it. Let's do another poll question here, and I do want to remind people as I start the poll, if you've got questions, put them in the Q&A panel. We will have a couple of minutes at the end of the presentation today to answer some of those questions.
We have had some good questions already, Robert. And the poll question, missing receipts are not an issue for the incurred cost proposal. True or false?
All right, it looks like most people have responded, so I'm going to go ahead and publish the results here. And the correct answer is false, right? Again, what I was just saying a few minutes ago, if you don't have receipts or invoices to back up what you're claiming, then they're going to be disallowed, and it's going to cause problems preparing the incurred cost proposal. It's going to cause problems in your rates, and you're going to have some unhappy people in management. All right, getting through the rest of our content here. I'm going to note here large variances, but I'm going to talk about some small variances in a moment. The accountant in me, I think Steve, Suzanne, we're all kind of the same. In the perfect world, everything would tie out to the penny. And boy, we love it when it does. Steve will sometimes tell me, I just worked on this reconciliation and it came out to the penny. And, and those are good days. Like, we love those days. Unfortunately, that doesn't happen a whole lot. There are many times, especially in the incurred cost proposal, and I would say even more, especially with Schedule L, we see variances. We probably have, of all of the clients that we do the incurred cost proposal, we probably have one or two where Schedule L ties out to the penny or within $1. Almost all clients have some variance in the Schedule L. It's a part of life, unfortunately. I mean, it happens. Part of what we have to go back to is materiality and determine, is it a material issue? If it's not, we do the best we can, we clean it up and we move on. There have been times where we've seen clients submit the incurred cost proposal with large variances, and guess what? DCAA is going to ask about it. We've seen, unfortunately, that we've had some small, truly immaterial variances, and DCAA has picked on it. I will tell you that sometimes you can go through and you may not be able to reconcile the variance, meaning that you can't make it go away, but you know what the cause, like you've narrowed it down and you're like, okay, I know this variance is due to this. I don't have enough other information to fully reconcile the issue. That's helpful. If you can at least show, hey, this piece of data came from here, this number came from here, this number came from here. We know there's a little discrepancy, and we know that the discrepancy is related to this. We just can't fix it. Put a note in there. Make sure that you explain that, because that explanation will go a long way too. The other thing, we've said a lot about this in today's presentation, is just data inconsistencies. Subledgers don't tie, invoicing doesn't tie out. T&M data is one. That Schedule K stuff is very interesting. If everything is in sync and people enter their time, you process labor distribution, it goes to the job ledger, it goes to the general ledger, it gets to the invoice, everything should line up. You should be able to print out a summary of invoicing information for T&M jobs, put it on Schedule I, and that would tie back to the timekeeping. But unfortunately, what happens is some of the things that I said before. People identify an issue at payroll. People identify some kind of an issue and they do a journal entry to the general ledger, but not to the job ledger, or they do a journal entry to the job ledger and they don't fix timekeeping. And so during audits, DCAA looks at this, right? They're going to say, hey, show us the timesheets that match up to this contract, that match up to this invoice, that match up to these total dollars. And when that doesn't match, you've got a problem. Subcontractor costs not being appropriately assigned. That's one that we see sometimes, is that clients will get the subcontractor's bill and pay it. They code it to subcontractor direct costs, but they don't associate a project with it. Or maybe they get an invoice that actually the subcontractor is working on multiple jobs and they don't break it out properly, right? And so now all of a sudden we have some inconsistencies and we don't have the appropriate level of detail that's necessary to report in the incurred cost proposal. The other issue is that schedules don't tie within the incurred cost proposal. You got to make sure that whatever you're claiming as total G&A costs on Schedule B ties out to what you're, applying those G&A costs to on Schedule H. Everything should cross-reference and match. Some other issues that we've come into, and we're down to the last few minutes here. Incorrect, inappropriate, or confusing indirect rate pools and calculations, meaning that they didn't align with business operations. There was an inappropriate allocation method. There were errors in the calculation. All kinds of things that can happen within the indirect rates themselves. That's a big area that we help clients with in general, but it's something that will kind of rear its ugly head, certainly in the middle of the incurred cost proposal. All right, let's get to a little bit of Q&A. We do have one more polling question. I want to keep everybody aware of that, and we'll get that on the screen here in the next couple of minutes. So Steve, if you want to ask me a couple of lingering questions out here, we'll try to get through what we can.
And before we dive into the content questions, a lot of people have asked if the slides will be available.
We will get those out to everybody, yes.
Great. So a lot of our questions go back to the subcontractor and temporary labor. We've had what's the difference between subcontractors and temporary employees? I'll let you start with that, and I'll keep finding some more questions here.
So I get my big clarification is always between our W-2 employees and somebody else's employee. So whether that's a temporary labor person that I'm getting from Kelly Services or some other agency, whether that's an independent contractor that I've hired to do either direct or indirect work, it doesn't matter. Whether it's a subcontractor organization that I've hired to do work, at the very least, we need to make the distinction between our W-2 labor and all other labor. Arguably, the distinction between temporary labor and subcontractor labor is temporary labor is usually somebody that you've hired to come into your facility to help you with your portion of the work, whereas subcontractor labor is actually another company that you've outsourced, right, a portion of that contract work to somebody else. Like if you were a general contractor, maybe you do the project management, maybe you do framing and foundation work, but maybe you have a subcontractor for electrical, a subcontractor for plumbing, as an example. Okay, if you hire temporary laborers to help you with the framing because that's your part of the work, that's temporary labor. That's not subcontract labor, right? The invoice you get from the electrical company or from the plumbing company, that's subcontractor. Part of the reason that's also important is that it can affect rate calculations depending on your rate structure, and that's a much bigger conversation than we have time for here. But it is possible, even likely, that depending on how your rates are set up, you may, for example, include temporary labor, and probably would include temporary labor in the calculation of your overhead, not fringe. Whereas subcontractor labor, you would not include in the calculation of fringe or overhead, okay? So that's one of the areas of some difference there. Let's go ahead and get the last polling question on the screen here because we're just about at the top of the hour. So let's give everybody a chance for this last polling question. The other questions that we didn't get to we will respond to you individually and get some information out to you. I do have a couple of more slides just really quickly after this last polling question here.
So the final polling question: how much help do you need with your ICP? A lot, a little, none, or unsure? And I do know Suzanne and I tried to respond to some of the questions that we didn't get to talk over with the group. So hopefully that will be helpful as well.
All right, let's go ahead and publish the result here of this final poll question. We'll get a couple of more things up here. We do have a lot of information on our website. We have 45 plus videos on our YouTube channel. This presentation will be available later today on our website. We'll also get a follow-up email out to everybody. You'll be able to download the presentation and watch the video again. We do webinars every month. Our webinar for next month is a little more on the incurred cost proposal, but we're going to specifically dive into the data aspect and talk about the type of data, where that data comes from, how to organize that data, how to configure your system to capture that data, and how that data flows through and is related to each other within the incurred cost proposal. And you can find that in all of our events on our website. Thank you again for participating today, and we hope to see you again next month. Take care and have a great day.
Thank you.
Bye.